Hello, my name's Simon Zutshi, and in this property education video, I'd like to talk to you a little bit about tax. Now, tax is not the most interesting subject, but when you're investing in property and making lots of money, you're going to have to pay tax. And actually, there are ways you can legally minimize the amount of tax you pay. So it's important to understand this because ultimately you can pay less tax, which means you've got more money in your pocket. Now, obviously it goes without saying, I am not a qualified tax advisor. I'm not trying to give you tax advice. I'm trying to give you a general education and overview of some of the questions you might want to speak to your tax advisor about. And by the way, it's very important to get individual advice based on your personal circumstance. And I highly recommend you work with a tax specialist and ideally someone who is a property tax specialist. You need to understand not all accountants and tax advisors are the same. You want to make sure you work with someone who really understands the intricacies of property investing. So with that in mind, let's go back to the basics and let me talk about 3 different types of tax which you're going to come across in your property journey. The first one, of course, is income tax. Now, income tax is based on what you personally earn. And the way income tax works, what happens is, if you imagine a ladder, okay? So the very first step, up to the first step on the ladder, which I think is about £12,750 at the time of recording this, you pay no tax up to that first step. Once you get beyond that step, you get into the next tax bracket, which is 20%. And when you go up to the top of that, which is about 50,000, you get into the next step, which is 40% tax, and eventually goes up to 45%. Now, tax rates are always changing. You can go on the HMRC website and check the current rates and make sure you're aware of what they are. But suffice to say, the first amount you don't pay any tax, then you pay it 20%, then you pay it 40%. So wherever you are on the ladder, if you get additional earnings, you pay tax on those additional earnings at that particular rate. So let's say you're earning £60,000 per year before tax. You would be in the 40% tax bracket. If you earn another £10,000 from your property investing, that's the profit, you would pay 40% tax on that £10,000 and end up with £6,000 in your pocket. So understanding the tax bracket is quite an important thing, understanding where you fit in that. Now, one of the first things I want to share with you when it comes to reducing the tax you pay is if you are in a partnership, if you're married and you have a partner, it might be that the different partners are on different tax rates. So let's say you are in a 40% bracket, but your partner is only in the 20% bracket. What you could do, if you buy a property together, this is in your own name, and you do it from a joint account, you can specify who actually has the beneficial ownership of that particular property. So it might be that your partner, who's only a 20% taxpayer, has 99% of the property and you have 1% of the property. So you both own it, but they have the majority of it, which means that when it comes to the profit, they get 99% of the profit, which will be taxed at their lower rate because they're in the 20% bracket. You're the higher rate, but you only get 1% of profit taxed at that higher rate. So that's a smart way of investing if you only maybe have 1 or 2 properties. Now, you've got to be careful. If someone is in a lower rate, because they're getting this extra income coming in from property or business, whatever it might be, it might push them up into the higher rate. So it's really important you are aware of the tax levels, the different steps on the ladder, so you know exactly which bracket you are in and when you're getting close to the next step to go up into the next tax bracket. So that's income tax. The next tax I want to talk to you about is called corporation tax. So if you have a company, the profits on that company are taxed at a fixed rate, typically 25% at the moment. Again, these change over time. So, for example, if you are a higher rate taxpayer, paying 40%, and you can't allocate any of that property to a partner, sometimes it might be better to be investing in a company structure because the tax in the company is only 25%. There's also a big change that came in April 2017. It was called Section 24, where the government changed the way that we as property investors are taxed. And what they said was, well, if you own property in your own name, which by the way, the vast majority of people did at that point, and if you have a mortgage, which again, most property investors have mortgages on the property, and if you're a higher rate taxpayer, which many investors were, they said you can no longer offset the interest on your mortgage against the profits to reduce down the tax you pay. Now, it's a bit unfair really, because every other business you can offset the genuine expenses from that business against the income to reduce the profit you make and thus reduce the tax you pay. So it's very unfair really, but that's the rules. And so what happened is many people decided to actually start investing within a company structure, because in a company structure you can offset all of the interest against the rental income to bring down your profit on which you are taxed. Now, there was a little loophole. If you use your property in your own name as serviced accommodation or furnished holiday lets, where you're renting out to tourists and it needs to be available for a certain amount of time, actually the interest on the mortgages, in that case, you could offset that against the rental income to reduce your profit. That's property in your own name used as furnished holiday lets or serviced accommodation. That loophole has just been closed in the spring budget by the Chancellor. So you can't do that anymore. So if you've got property in your name and you've got a mortgage on it and you're a high rate taxpayer, you are going to be affected by Section 24. This is one of the reasons you see many landlords selling up property, getting out of the game, because they've had really good capital growth over the last 10, 15 years, and now they're selling up and taking some of that profit. That leads me nicely to talk about the next tax you need to be aware of as a property investor, and that is capital gains tax. So if you buy a property that's not your own home, and over time it goes up in value, and in the UK we live in an island with an increasing population and a limited supply of accommodation, so over time property prices generally tend to go up. Doesn't always happen. We have a cyclical market, prices come up, they come down as well, but on the general trend in the UK, property prices go up. So if you buy a property and after 10 years it's a higher value and you sell that rental property, you will pay what's called capital gains tax. And it's the difference between what you bought the property for, what you sell the property for. You can include the buying and selling costs and also any capital improvements. So if you come in and put a new roof on a property or something, or you do an attic extension, that is a capital improvement to the property. And you can offset those to reduce the capital gains tax. So when you sell a property, you obviously are going to pay capital gains tax if it's not your main residence. The government has just announced they're reducing the amount that people in the higher rate tax bracket pay for capital gains tax. It was 28%, it's come down to 24%. Now that's still 4% above other types of capital gain tax, so it's a very taxed asset property, but that's come down. Now, I think there's going to be lots of landlords who might say, oh, actually, if I sell my property now, I can probably pay less tax. And actually, if the Labour Party come in, they might well increase the amount of capital gains tax, especially for higher taxpayers, because they see it as an easy tax on wealthy people. So I think we'll see a lot of landlords looking to sell in the next 6 months or so there'll be more property coming onto the market, which is an interesting opportunity for us. Now here's something else you need to understand, and that is if you own a residential property that you live in, you can buy that, sell it for more money, and at the moment you pay no capital gains tax. So one strategy you can use to minimize your tax is, some people, they buy a property they want to renovate, they want to add value to it to increase the value, but they live there as their own home. They then sell it and move to another property that needs improvement. So each time they're going up the property chain, they're going up the ladder, getting a bigger, more expensive property in a better area, and often having a very similar small mortgage, but they're just using the profit from the last development they've done to put in as a deposit for the next property. So what this means is, I've got a number of friends who live in very nice, big, large houses with very small mortgages because they've just bought a property, they've done it up, sold it, paid no tax because it was their own residence, moved to the next one, and they've gone up the ladder. So that's a great strategy you can use. The other thing you can do to minimize the tax you pay is if you have a property and you do repairs to that property. So let's say every so often you need to replace the kitchen, the cost of the repairs can be offset against the rental income coming in, again, to reduce your profit. So what that means is, over time you're increasing the value of your property, you're sustaining your portfolio, keeping it in good condition, which means you can maximize the rental income coming in, but the cost of repairs you can offset. Now, if it's improvements to a property, so you're adding an attic or you're doing a rear extension, that is a capital improvement. You cannot claim that against the rental income. You'd actually have to add that to take it off any capital gain if you sell that property. Interestingly, if you never sell property, you never pay any capital gains tax on it. Let me say that again. If you don't sell, you don't pay capital gains tax. But you might think, well, what about when you die? And that's the final tax I want to talk about, which is inheritance tax. Now, you might not be thinking about inheritance tax. It's a long way away, but we never know how long we've got. And at some point, if you have lots of assets and you die, you can pass everything to your partner and there's no tax to pay. But once they die, there's going to be tax to pay. In inheritance, there are some personal allowances, but inheritance tax is 40%. So the reason there's no capital gains tax, because capital gains tax at the moment, at the high rate is 24%, inheritance tax is 40%. Guess what? The government would rather tax you on 40% on your assets rather than 24% on capital gain. So at the point of death, there is no capital gains tax to pay. It's inheritance tax instead. And I recommend if you're starting to build a big portfolio, you should definitely get some individual advice based on what you want to do to have some good tax planning in advance. Very often you see people who are in their late 70s or 80s, they've got lots of assets, they think, oh, maybe I should do some planning now. And it's possible at that age, but it's a bit more complicated. It's much better if you start in your 30s, 40s, thinking about how am I going to plan? So I want to create wealth and leave it to my generations. There's definitely right ways and wrong ways of doing it. For example, a big mistake people make is they might have life insurance. It's good to have life insurance because people say, well, whilst I've got all this property and I've got all the debt, wouldn't it be good to clear all the debt? And you can absolutely do that. The problem is if you have life insurance coming into your name, you're the beneficiary, your estate's the beneficiary, that life insurance is going to be taxed at 40%. It's much better to set up a separate family trust. The insurance goes into the trust and your beneficiaries can then borrow that money from the trust to clear all your debts. So everything's possible. There's always a way to do things, but you just need to find the right way of doing it. And very often people try and do things for free, they try and do things on the cheap. This is one of those areas where you need to develop a value mindset instead of a cost mindset. A cost mindset is where people look at the cost of doing things. Oh, I don't want to pay an accountant a lot of money to do my figures for me, I could just do my tax return myself. Well, you could do, but if an accountant can save you lots of money, and by the way, a good accountant should save you more money than you're going to, should save you more tax than you're going to pay them. So you should be net to net anyway. But so many people, they don't like spending money. They've got this cost mindset and they're not looking at the value. So a big tip I would give you, if you want to be a successful person, start developing a value mindset. We look at the value of things rather than the cost of things. So there's a few ideas on how you can save yourself money or save yourself tax. One is if you've got property in your own name and you're a high rate taxpayer, maybe buying in a company structure might be a good thing to look at. If you are looking to sell property, you buy it up, renovate it, maybe you sell there and you've got to intend to live there for a while, actually there's no capital gain and you can move way up the ladder. And there are also lots of other tax savings you can do. You can get repairs, you can offset those. The final thing I want to mention is if you have a business, you can offset a lot of expenses through that business. So you should be putting your mobile phone, and obviously they have to be legitimate expenses that are incurred for the business. But if you've got a nice new laptop you're using for the business, why doesn't the business pay for that? Maybe they can pay for your mobile phone bill. Maybe they can pay for the mileage when you're visiting your property. So it's got to be genuine costs incurred. If you do a training course, that can be put 100% through the business. If you have life insurance, that can be put through the business. All these things that you might be paying personally from your pocket, which is money after tax, it's much better to pay for it from the profit in the business before tax. It's a much smarter thing to do. So I do hope this video has been useful for you. If you like it, please like the video. Make sure you subscribe to make sure you get these videos every time they come out, and hit the bell icon to make sure you are notified. Remember, I cannot give tax advice. This is not tax advice I'm giving today. This is just education to make you aware of the questions you need to be asking your personal tax advisors. How do you find good people to help you? Well, use word of mouth recommendation. Go to a local property investor network meeting maybe, ask around, find out who they are using, speak to a number of people, whoever you resonate with as long as they're qualified, get some individual personal advice to make sure you're minimizing the amount of tax you need to pay and doing it correctly and also doing it legally. So my name is Simon Zutshi. I hope you enjoyed this video. Hit the like button, make sure you subscribe, and as ever, I encourage you to invest with knowledge, invest with skill. Hello, it's Simon Zutshi here. I do hope you just enjoyed that YouTube video. And you know what? If you really want to move forward in your property investing, it's much easier to do it with the help of other people. And one of the best things you can do is go to your local property investor network meeting where you can meet other like-minded people. You can learn some of the very best strategies and really get a motivational positive boost every single month about what you could achieve from your property investing. Now, there are 50 plus meetings around the UK. We've got meetings in the Netherlands, we've got them in the UAE as well, and growing around Europe. So all you have to do is click on the link below this video, go to pinmeeting.co.uk. All the meetings are listed there. Click on the one that's closer to you. See when the date and time is, and if you want to attend that meeting, you're going to just buy a ticket, or if you want to come as my guest to your very first PIN meeting, just use the voucher code, which is the word YouTube, because obviously you've watched the YouTube video. So just go to pinmeeting.co.uk, pick your location, scroll down where it says payment options, click on pay with a voucher code, fill in the details, use the word YouTube, and it will bypass the payment page and you can come to your very first PIN meeting for free. If you haven't been yet, I highly recommend you come along and see exactly what you've been missing out on. You're going to wish you would have gone years ago. It's going to help you move forward massively with your property investing. So if you enjoy these videos, I highly recommend you go and check out the PIN meeting. Click on the link below in the description. Invest with knowledge, invest with skill, and enjoy the next video.